Great. Apology for the technical difficulties here. First of all, thanks for coming. I'm a lawyer and I work a lot with VCs and startups. And one of the most frequent questions I get is, or I'm involved in, is the valuation question, which is, money, money, money. And everybody's interested in the money thing, and it turns out it's the valuation question. I don't have a corporate finance background. I'm a lawyer, so I am interested in the numbers, but more than the numbers, I want to show you how there are different ways of thinking about value and how to evaluate companies at different stages of growth. But most of all, I feel there's a huge disconnect between valuations and company growth. So that's me, matches, right? Some stuff about me. I'm a lawyer, so I have to put these disclaimers. I'm not going to, no attorney-client relationship, no attorney advertising, and no tax avoidance. And I am going to say a couple of controversial things, I hope. So let's have a discussion, and let's go. So what's the controversy? The controversy, prices are crazy. You have companies that after 14, 16, 18 months don't have a product, they might have a feature, and prices are just going crazy. For example here, Instagram, after 18 months being out in the world, is worth $1 billion to Mark Zuckerberg. Snapshot, $2 billion. Nest, they have a product, but for Google, it's a $2 billion company. Nest has small sales in the US. It's not huge. Oculus, I thought Oculus was for nerds. WhatsApp, $19 billion. I mean, for $19 billion, Vladimir Putin almost bought the Ukraine. So it's unbelievable. So WhatsApp is the size of, Ukraine. It's crazy. And then we have companies like Estimote here in Krakow, which are on a huge growth trajectory. In 3 months, they raised $3 million. And that tells you something about valuation. They were in, as everybody knows, they were in YC for 3 months. And after 3 months, they were capable of raising $3 million on a convertible note. Intel Clinic, another company from the Polish ecosystem, raised almost $500,000 on Kickstarter. Based on a story, not a product. It's a product with a prototype, but it hasn't been, it's based on a story. So I did some math. I went to Angel Co. and I looked at different valuations. You can do things by schools. You can do things by, again, I'm sorry for this. Okay, so average valuation of a company for Y Combinator, 6.4, and the range is between 5 and 8 million. For a grad student from Stanford, if he does a startup, the valuation is on average 3.3 million. If you work at Google, the average valuation is 3.7. If you're doing a hardware company, it's 4.3. Mobile security company, so cybersecurity, it's 5.8. A bit crazy. Now I want to show you by geography. So Poland, average valuation of a company is 3 million. Bulgaria, I'm involved in the Bulgarian tech ecosystem, is 1.3. New York City, where I work, it's 4.2. And Silicon Valley is the usual valuation is 4.7. So interesting numbers, and the stuff about the valley, you can break it down even more into San Jose and look at prices in San Jose, Redwood City, San Francisco itself. So that's just some data points. So are prices too high? I would say It depends, and it depends because we need to, as people who are working with startups, we need to reassess how we think about valuations. One of the key things is U.S. monetary policy. Interest rates are at historical lows. Investors are looking for high yields, so they're looking into tech companies for a return on their investment. Prices are going up. Does anybody know how much what is interest rates on Greek bonds? 4.7. So Greeks who are super risky are trading at 4.7. So you give them $100, you get 4.7, which means Greece is not risky. So people are investing in tech. And this is one of the factors that I think might be driving prices up. Disclaimer, I'm not saying that there's a tech bubble. There's a potential for it. But going to the next slide, we're in the middle of a digital revolution. Google was established in 1998. They figured out their business model in 2004. And they were valued in 2002 at crazy numbers. No one thought that this would make any sense. But two trends here. First of all, software is eating up the world. It's traditional business models are being destroyed, disrupted, and revolutionized as we speak. The other thing is, it's not clear if we're at the peak of the mountain or we're back in the valley. So it could be, if we believe that the Industrial Revolution happened 200 years ago and it destroyed the horse and the traditional manufacturing system, we're right now, it seems, at the very beginning of the digital world. And a lot of people who are investing, that's their investment thesis, that we're not in the peak. This is just the beginning. And it's part of, if you're building a valuation model, this is one of the elements. You got to know, you have to make that decision for yourself. Is it a peak or a valley? And digital cassettes, this was like 95, and it's gone. No one does cassettes anymore, and no more mixtapes. Okay, so the digital revolution is not only destroying traditional businesses, it's also destroying traditional valuation models. In tech or in software, there's no physical buildings, there's no physical assets, there's no receivables. It's all different. So this means we have to think differently, again, about how we think about valuation. So valuation, the traditional methods. So you have the market method, so you look at comparables and you compare the Google to Alta Vista, but if there's no blah, blah, blah. So we know that. Asset method. So if there's assets, you have inventory, you look at the inventory and you compare inventory and then you move on. Then the income method, which is, classic DCF. So you invest in Polish bonds or Greek bonds, and or German bonds, right? That's the gold standard now. And then you compare. And then, with the income method, you probably hear about the price to earnings ratio. So you look at the price of the share, and then you look at the earnings. So it's more for public companies, but those are the Wall Street folks. These are the methods they use. So valuation misunderstood. Totally. It's highly subjective. The value when we talk about value, it's the private market by VCs. It's not the public market, so that's one thing. And again, you're not comparing anything to anything. So valuation is temporary. A lot of founders I talk to and work with, they're always obsessed about a number. Oh, we're valued at $2 million. We're valued at 3. It's only a temporary thing, and it can go down, and it doesn't really mean anything. Okay, investors, they always focus on the current value. When a founder speaks to, when a founder speaks to an investor, an angel, they talk about future value. But, they have to meet in between. So, future current value. Okay, so traditional valuation models, it's always about measuring multiples. So price to earning ratio, that's like the big one. And that's why a lot of people in the traditional world do not understand how to value startup companies or tech companies, because there's really no profit, there's no assets. For them, it's something they really don't see as valuable. So you can have a great company like Instagram, or what I like Instagram, because they really didn't have any income. They have something which got Mark Zuckerberg interested, but I'm going to get to that in the next slide. So what is the value looking for? What are tech investors looking for? They're looking for growth verticals. So things that they can integrate into their platform, and things that will be able to grow in the 20 to 30 year growth plan. And you'll hear this, we're looking for real estate that will expand. And they're looking for vertical killers. And again, ability to grow verticals and vertical killers are the things that are put in the valuation model. So these are the assumptions that go in, and if the things that I'm going to start mentioning on the next slides are in your company, your valuation is going to go up. So, conversion, retention, engagement. This is the essence of the lean startup methodology. It's not about building additional features and having, more beef or more room. It's actually about conversion, converting likes or tweets, retaining those tweets, those likes, and then being able to engage. So look at Instagram. They had nothing, but they had huge conversion rates, retention, and engagement. Teenagers were nonstop on Instagram, and that's what drives prices in the valley. If you have huge retention and are capable to engage your customer, and there's the feedback loop, the price goes up. That's why Facebook did so well. That's why Twitter is doing so well, because everybody is on Instagram, they're on tweets, on Twitter, and they're tweeting. So again, in the valuation model, there's always, this is the thing they're looking for. So it's not only, okay, it's a great business model, but it changes the fundamentals of the game. I have a client that's building a platform to do X and get people somewhere to do something. And it's a great company, and they're going to raise the their $1 million raise. However, the company doesn't change the fundamentals. So Instagram, Facebook, Twitter, Google, Estimote, they change the fundamentals. Estimote's assumption is that they're going to change the way people do retail and do other things. Yeah. So again, are we at the beginning of the tech revolution, or are we at the end of it? Investors in the Valley believe that we're at the very beginning, so this drives the valuation. So they're looking at a 10 to 30 year perspective. Again, Google, established in 1998, 2002, business model. I think in 2004 or 5, they bought YouTube for $1.8 billion. They didn't know what to do with it. It took them 4 to 5 years to get to the next stage, to create value and monetize on the business model. Same thing with Facebook. Established 2004, in 2010, they started to get some revenue. So that's on the valuation, that's the perspective. Okay, so scalable business model, that's the next element. You can have a lot of great businesses. I heard here someone pitch me the idea of an application that helps cheating. So no one can find out that you're cheating, and yeah, it's a anyway. But point being, yeah, if it's scalable and it has a business model that can scale, then it works. Technology adaption, also AKA virality. If the thing is viral, and this is snapshot, if it's viral, it makes sense. Okay, so I told you, valuations, big numbers. And then you have guys like Paul Graham who say valuations do not matter for early stages. So we just talked about the numbers should be small, should be realistic, but then it turns out it doesn't matter. And why doesn't it matter? Because valuation is just a number that tells you about the probability of getting to the next stage. It does not tell you that this is worth so-and-so and you're going to get so-and-so. It only says that to get to revenue, it'll take the following steps. So it's just a metric of getting to the next stage. Nothing more and nothing less. So this means also that valuation is about the cost of running experiments and having a 3-month, let's say, runway for fundraising. This sort of redefines the way how we think how tech valuations work. So it's about paying for mistakes. So you borrow money from VCs to make mistakes. So when you're negotiating with VCs and investors, it's not like going to the bank and there's a rate of return on the investment or an ROI or an RRR, right? It's about financing mistakes. So this means that valuations are about mistakes and making mistakes of other people's money. So VC mistakes and pricing and how all of this works in evaluation. So for example, if there's a fund that has made 10 investments, statistically, 8 or 9 are going to do very bad. Even with due diligence, hard work, 8 to 9 are going to fail. And to make the whole business model work for VCs, the valuations or the rate of investment on each one of the portfolio companies has to be around 30%. That's the target rate that they're promising a return to the LPs. So 30%. So they lost all of their money going from portfolio company 1 to 9, and then in company 10, what number do they need? Is it 30% or more? It has to be more than, we just lost all of the money in company 1 to 9, right? So we need to make the difference in company 10, get 30% plus go for the big bang. This is what Bartek Gola was telling you yesterday about the black swans. And that Americans are obsessed about the black swans. They're obsessed because that's how they work their valuation models. They're looking for that big home run that will cover all of their losses going through 1 to 9. So that's why they're so funds are so picky with investments and the pricing formula for the valuation. Okay, so price and ownership. you can have a pricing model, but the pricing model is based on how much ownership you take and how much you'll have. And this is, the question that keeps coming up here in Eastern Europe, that VCs here take a bigger chunk of the company than in the Valley. Or point being is that they're taking more risks here, and they're pricing it through taking more ownership. Okay. So dilution in the next round. What we sort of talked about is a very static model. So the model is there's only one round. But if you're doing multiple rounds and you go to A, B, C, D, E, the pricing model and the valuation also changes because you have other investors on top of you, on top of the founders, and that changes the dynamic of working the numbers. Okay, so the last slide, this is going to be the controversial one. Founder-investor collusion. I think a lot of the valuations are driven by founder-investor collusion. So the founders are greedy, the investors are greedy. They lost all of their money between in portfolio company 1 through 9, and they're looking for the next fool or thief to go in. And if you're doing these rounds for company 1 to 9, the bad ones that really suck, this happens. The investors are trying to get out, and they pump up the number for the valuation, and the founders do the same. And it might be, consciously or subconsciously, but it happens. So that's why, a lot of, deals I feel are mispriced. So anyway, thank you. Like us, follow us on Twitter, and thanks for having me. I can take, how are we doing on time? I can take some questions.
Yeah. Do you have any questions? Just
Yeah, so what I'm interested in is the dangers of having a very high valuation. If you could talk a little bit about that.
Yeah, so high valuations. For me as a lawyer, I look at ownership. Ownership and control is important for me. And the way a lot of founders and VCs get out of this problem of if they don't have enough control and power, they try to jack the valuation. And the valuation is higher, and the less stock they have, it doesn't matter because they want to get to a number, let's say 100, and you can do it through either a higher valuation or more, control of the company. So I feel the high valuation, it can be either high valuation and high dilution, low dilution, high valuation, low dilution, low valuation, or low valuation and low dilution. So the best model, in my opinion, is high valuation and low dilution because it works for founders and investors. And, everybody has their own incentive. The valuation only matters at exit. Till the exit, it doesn't mean, it's just one of the metrics of, how good you're doing.
Can you elaborate on how preferences affect valuations?
What's that?
Preferences, investor preferences, do they affect valuation?
Yeah, so the preferences, so it's for the people who are just starting off, the preference is how much the investor gets. And it could be, there's always a preferred amount, and it's original price, or ×2 or ×3. There can be a cap, and sometimes it's participating, non-participating. The guys at the early stage, you're just praying and praying that it's going to work out. The guys at the growth stage, they really care that all of the numbers, makes sense. So
So you say typically it's just a simple preference, one
Yeah.
times multiple, and
Yeah.
that's it. Okay.
So early stage, so it's usually preferred non-participating times one original price. Later on, it gets to preferred participating times something. And there's usually a fight between the early stage investor who's like, I scouted the deal, with the guys who are the growth stage guys and like, oh, we're going to scale the business and we're going to make it work. I love the enthusiasm. Woo! Eastern Europeans. You rock.
So Tytus, you know, something that I notice very often when founders that don't have a lot of experience get into this whole conversation, you know, what are the, you know, and I'm being asked very often by people to explain how it works. What is your opinion and how do you explain valuation ranges? So you're going to investors. Now, we all know that, you know, in Eastern Europe, the smaller the town is that you go to, or the smaller the country here in the region, usually, you know, the more difficult those conversations are. What are acceptable ranges for valuation at, let's say, acceleration or early seed level, seed, Series A? What do you... Oh, there you go. I didn't. I came in later. I didn't see the slide about Bulgaria. Very good.
Yeah, so like, it's a you know, the question behind Max's question is how, you know, you put so much work and effort into it. How do you value that? My, like, when I represent the founders, I usually tell them, okay, write down in an Excel spreadsheet how many hours you worked on this, day by day, and put like a price point. If you're a dev person, my time is $60. So I put, you know, 100 hours times 60, so that's like, you know, one way to do it. Then you can go on GitHub and look at, you know, pricing for code or how, you know, things are priced. So like you can take it, you know, piece by piece, but I feel people are not that sophisticated in, you know, showing how the numbers work and put their work effort.
One follow-up question on this, and how do you suggest to deal with for equity not for money?
What's that?
So services equity. So when someone is, because you know you have these media for equity investors. I've noticed in some smaller countries in this region that you know you have like local marketing companies or people that are generally connected that are offering services for equity. What is your advice on this?
So in general, I am a big proponent of taking equity in companies, especially in early stage companies. So as a law firm, we take equity in startups because, you know, you're not going to pay us anyway. We want to do good and we want to help you out, but, you know, we want to take equity. So in general, advisors are between 2 to 3%. Service providers, like, you know, as a law firm, we take 0.75, and that's the standard on the East Coast. And on the West Coast, it's 125 for, you know, doing, you know, legal services. But in general, you know, it's, you know, America. Everything is negotiable. You can negotiate this. And the other thing you want to do is, you know, you want to make sure that if you're going to take an advisor, the equity distribution is on a vesting schedule. So, like, you know, he's going to be there for 2 years, and he's going to do X, Y, and Z for you during that time. And there's a commitment, you know, I'll do 4 hours of work for you during the per week. Microphone.
Sorry. To your point that you said about taking equity for services, do you actually take equity, or do you issue a convertible note
Very
to
good
be
question.
valued at the next investment round?
Okay, so what we do is in our engagement letter, we write that we will have the right to purchase. So at nominal value with the founders.
So you actually define the amount in dollars for which you will provide
There's different ways to
services,
do it, yeah.
and the percentage that you will end
Yep.
up with is not defined at that.
Yeah,
at that
and this
moment,
helps, you know, and this helps to build, you know, the value proposition, right? So, someone took, 3% of company equity for, $50,000 worth of work, right? Or for marketing services. And it just, helps to, build the value proposition.
But, in the early stage company where valuation is very difficult, as we agreed, you say you take 1.5% at $50,000,
Yeah.
which effectively you give it the valuation.
Yeah.
So you take the standard valuation, I guess, then in that
Yep.
case. Okay.
Okay, thank you very much. Big applause.
Thank you.